Disclaimer.
While Wall Street celebrates the evening close of trading, knocking down the price of paper silver to $89, in the real world, a tectonic shift has just occurred. Today, January 15th, we have officially crossed the point of no return. At this very moment, while the American charts are drawing red, dealers in Australia and Asia are selling physical metal for over $100 an ounce. This is not just volatility. This is a collapse of the system. Today, I will show you the data that the mainstream media is silent about. How China blocked exports, why banks are burning their last paper shorts in desperation, and why $100 is just the beginning for those who hold real metal in their hands, not numbers on a screen. Welcome to the reality of the silver shockwave. Pop quiz. What happens when the price of something shoots up 40% in less than 2 weeks, while banks that bet against it are hemorrhaging billions they don't have? We're about to find out, because silver just broke $91 this morning. And the entire paper pricing system that's controlled this market for decades is collapsing in real time right before our eyes. Here's what should grab your attention immediately. While silver trades at $91 on Western exchanges, physical metal is selling for $130 per ounce in Japan and $106 in Kuwait. That's not a typo or a temporary premium you'd see during high demand. We're watching 80% markups on actual silver bars and coins, which tells us something far more alarming than a simple supply squeeze. The paper contracts our major banks have used to suppress prices for years can no longer deliver physical metal when investors demand it. Think about what that means for your retirement account, your savings, your understanding of how our financial system actually works. For decades, we've been told that markets reflect supply and demand, that prices discover themselves through free trading, that regulators keep things fair. But right now in our country, JP Chase and other major banks face margin liquidation from massive short positions. They took betting silver would stay cheap, and this crisis is hitting at the absolute worst possible moment for them. 6 days from now, on January 20th, Trump's deadline arrives for his proposed 10% cap on credit card interest rates. You might think that sounds great for consumers, and maybe it is, but here's the calculation banks are making behind closed doors. That single policy proposal threatens to wipe out more than $50 billion in annual revenue from their credit card divisions, and they are scrambling to figure out how to replace that income, while simultaneously bleeding money on silver positions that are moving violently against them. The $920 million fine JP Morgan paid back in 2020 for precious metals manipulation looks like pocket change compared to what they're facing now. Have you noticed how quiet our financial media has been about this? There's a reason. On December 26, while most Americans were enjoying the holiday week, the Federal Reserve quietly injected $17 billion in emergency cash to an unnamed bank. The Fed's balance sheet shows it plain as day, but nobody reported it. Nobody asked which bank needed that kind of immediate liquidity during what should be a calm period. That emergency injection happened just days before silver started this historic run toward $100, and the timing should make every American investor pay very close attention to what's really happening in our banking system. But here's where it gets interesting, and this is where you need to understand the bigger picture. On January 1st, China weaponized silver in a way that most analysts completely missed. Their government issued licenses to only 44 approved companies for silver exports, capping the total at 121 million ounces annually. According to the World Gold Council, that represents 60 to 70% of global silver supply. China didn't ban exports outright, which would violate trade agreements. They just made sure they control exactly who can sell and how much they can move. And meanwhile, their domestic buyers are panic buying physical metal at any price because they see what's coming. Let me put this in perspective with a scenario you can relate to. Imagine you're planning a vacation to Japan this summer and you want to lock in your currency exchange rate today. You go to buy yen, and the exchange shows one rate on the screen. But when you actually try to convert your dollars, they tell you the real price is 80% higher. You'd immediately know something catastrophic was happening with the dollar, with the exchange system, with the fundamental mechanics of how money works. That's exactly what's happening in silver markets right now, except instead of vacation money, we're talking about a strategic metal that goes into solar panels, electronics, medical equipment, and military applications. The banks that held silver prices down through paper contracts on the COMEX exchange thought they had an infinite timeline to manage their positions. They've done it successfully for decades, slowly accumulating shorts, occasionally getting fined for manipulation, paying those fines as a cost of doing business, and moving on. The Justice Department even sent 2 JP Morgan traders to federal prison for spoofing silver markets, and still the game continued. But something fundamental changed in the past 2 weeks that broke their control. What changed wasn't just demand or some technical chart pattern. According to COMEX trading data, the exchange dramatically raised margin requirements multiple times over the New Year holiday. with increases ranging from 30 to nearly 50%. When exchanges raise margin requirements that aggressively in such a short period, they're sending a clear signal. They see volatility coming that could threaten the integrity of the entire system. They see positions so large and so underwater that normal margin levels won't protect them from default. Scotiabank already exited the precious metals business completely. They were one of the major market makers, and they just walked away. Meanwhile, JP Morgan, which normally closes out its positions before contracts expire, just took delivery of more than 1,000 COMEX contracts. They're accepting physical silver delivery instead of rolling their positions forward, and that reversal in their usual pattern tells us they've changed their entire strategy. They're no longer betting on prices staying low. They're covering their shorts and accumulating physical metal because they know what happens when the paper system breaks. Think about this from your own financial perspective. If you own mining stocks in your portfolio, or if you've ever considered precious metals as insurance against currency debasement, you're watching the price discovery mechanism collapse in real time. The paper price and the physical price used to move together, with maybe a small premium for coins or small bars. But now we are seeing premiums that indicate the paper market has completely lost credibility as a pricing mechanism. The S&P Banking Index dropped sharply this week, while Federal Reserve Chairman Powell faces a criminal investigation. Banks are preparing to report their fourth quarter earnings, and the guidance they're giving for 2026 outlook is universally described as cautious. That's banking industry code for we have no idea how we're going to make money under the new regulatory environment. This isn't a solvency crisis where banks don't have enough capital to survive. This is a profitability crisis where they can't generate returns for shareholders under the new rules, and that distinction matters enormously for what happens next. Here's what you need to understand as an American watching your financial system face this moment. Basel III regulations, which went into full effect recently, force banks to hold 85% capital against unallocated silver positions. That means for every paper ounce of silver they've sold short, they need to hold 85 cents in reserve capital. The problem is that the ratio of paper silver to physical silver is estimated at 300 to 1. The banks literally cannot meet these capital requirements against positions they've built up over years, and they have to unwind those positions into a market where physical metal is becoming increasingly unavailable. January 20th isn't just about Trump's proposed credit card rate cap deadline. It's the convergence point where multiple policy pressures collide with a derivatives time bomb that's been ticking for decades. Our major banks need to find ways to potentially replace $50 billion in threatened revenue cover margin calls on silver positions, moving against them by double-digit percentages. Daily, meet Basel. 3 capital requirements they can't possibly satisfy with current position sizes, and do all of this while physical premiums indicate the paper pricing system is already broken. We're not talking about a hypothetical crisis or a prediction about something that might happen. We're watching it unfold in real time. And most Americans have no idea that the stability of our banking system is being tested right now by a metal most people think is just for jewelry and coins. Every few years, someone on the internet predicts a banking crisis or precious metals explosion, and every few years, the system limps along and proves them wrong. So why should you believe this time is different? Because for the first time in decades, we have concrete regulatory mechanisms forcing banks into a corner they cannot manipulate their way out of, combined with physical market dynamics that make their paper positions mathematically impossible to cover. Let me show you the data that separates this moment from every other crisis warning you've heard before. Basel III banking regulations went into full effect recently, and most Americans have no idea what that means for silver markets. Here's the simple version that matters for your investments and our banking system. Under these new rules, banks must hold 85% capital reserves against any unallocated silver positions they carry on their books. Think about what that actually means in practice. If a bank sold short 1 million ounces of paper silver contracts, they now need to set aside capital equal to 85% of the current market value of that silver, even though they never intend to deliver the physical metal. The problem becomes catastrophic when you understand the ratio. According to commodity market analysis, the paper to physical silver ratio sits around 300 to 1. That means for every actual ounce of silver that exists and can be delivered, there are 300 paper claims on that same ounce. Banks have been running this game for decades, selling contracts they never expected to fulfill, collecting premiums, and managing the positions through more paper shuffling. But Basel III just changed the entire equation by forcing them to hold massive capital against positions that were never designed to require capital in the first place. CME Group, which runs the COMEX exchange where most silver futures trade, responded to the recent volatility with a series of emergency actions that reveal just how serious the situation has become. The exchange raised margin requirements dramatically multiple times in just days around New Year, with some increases reaching 30% and others climbing to nearly 50%. These weren't small technical adjustments. When you're trading silver futures, each contract represents 5,000 ounces. These margin hikes meant traders suddenly needed to post tens of thousands of dollars in additional collateral per contract just to maintain positions they already held. Here's what should grab your attention about the timing and scale of these moves. Scotiabank, one of the most established names in precious metals, trading going back over 300 years through its Macata division, already completely exited the metals business. They shut down operations, walked away from centuries of history, and left the market entirely. Meanwhile, JP Chase, which normally rolls its COMEX positions forward or closes them out before delivery, just did something extraordinary. They took delivery of more than 1,000 contracts of physical silver instead of settling in cash or rolling the positions. That's over 5 million ounces of actual metal that JP decided they needed in their vaults, rather than maintaining paper exposure. Think about what this behavior tells us. The largest banks in our country, the ones with the most sophisticated trading desks and the deepest understanding of these markets, are either fleeing entirely or suddenly accumulating the physical metal they spent decades suppressing the price of through short positions. This isn't speculation about their motives. This is observable action in public markets that contradicts everything these banks have done for the past generation. The S&P Banking Index dropped sharply this week, and the financial media mostly ignored it or attributed the decline to general market conditions. But look at what's actually happening inside these institutions. Federal Reserve Chairman Jerome Powell, who's supposed to be one of the most protected figures in our financial system, faces a criminal investigation announced just days ago. Whether you think that investigation has merit or not, the mere existence of it creates uncertainty about the independence of our central bank and the stability of our monetary policy framework. Banks rely on predictable Fed policy to manage their massive derivative books, and right now, nothing feels predictable. Major banks are preparing to report their fourth quarter earnings in the coming weeks, and the early guidance they are providing analysts includes words like cautious when describing their 2026 outlook. The corporate speak translates to something much more serious than temporary uncertainty. These banks are telling investors that they cannot figure out how to generate acceptable returns under the new regulatory environment combined with the political pressure they are facing. This is a profitability crisis, which sounds less scary than a solvency crisis, but in some ways it's more dangerous for what happens next. When banks face solvency issues, regulators step in, arrange mergers, inject capital, and stabilize the situation because the alternative is immediate collapse. But a profitability crisis means banks remain technically solvent, but cannot make money for shareholders under current conditions. That creates an extended period where banks need to fundamentally restructure their business models, shed unprofitable operations, and potentially exit entire lines of business. The precious metals desks that have been quietly printing money through manipulation for decades suddenly look like exactly the kind of volatile, capital-intensive, politically sensitive business that banks might decide to shut down entirely. Now let me show you why the shorts these banks hold cannot simply be unwound quietly like they have done in the past. Silver's price gained 144% in 2025. That's not a typo or an exaggeration. The metal went from around $30 per ounce at the start of last year to over $70 by year end. That kind of move should have bankrupted the short sellers, yet somehow the major banks survived. They survived because they could manage their positions in a market where paper contracts still dominated and physical demand remained relatively modest compared to the paper trading volume. But here's the part that should make every American investor pay attention to what's different this time. That 144% gain happened after the industry already paid massive penalties for the exact manipulation these banks are still engaged in. Between 2016 and 2025, 8 major banks paid a combined $1.27 billion in fines specifically for precious metals market manipulation. The Commodity Futures Trading Commission, the Department of Justice, and the Securities and Exchange Commission all investigated and penalized these institutions for the illegal practice of spoofing, which means placing fake orders to move prices in directions beneficial to their real positions. 2 traders from JP Morgan's precious metals desk, Michael Nowak and Greg Smith, actually served time in federal prison for their roles in this manipulation scheme. Not civil penalties or corporate fines, actual prison sentences. The Justice Department proved in court that these weren't rogue traders acting alone, but rather that the manipulation was systematic and known to senior management at the bank. JP Morgan itself admitted to the conduct and paid $920 million to settle the charges. And still, the game continued. So, when silver started its historic run in 2025, these same banks that had just paid over $1 billion in fines and seen their traders go to prison were still holding massive short positions, betting the price would stay low. They thought they could outlast the momentum, wait for technical corrections, and gradually unwind their exposure like they always had before. But 3 things changed that broke their strategy completely. First, The physical market began to decouple from paper prices in ways we've never seen before. Industrial users who actually need silver for manufacturing solar panels, electronics, and other products started paying premiums of 30, 40, sometimes 50% or more above the paper price just to secure physical delivery. That premium structure tells you the paper market has lost credibility as a price discovery mechanism. When the actual users of the metal are willing to pay 50% above the exchange price, it means the exchange price has become fiction maintained only by banks shuffling paper contracts among themselves. Second, the short positions that banks built up over decades, assuming they could always roll them forward and manage them with more paper, suddenly ran into Basel III capital requirements that make the positions prohibitively expensive to maintain. It's not that banks don't have the capital to meet these requirements, technically. It's that deploying that much capital to hold short positions in a metal that is rallying 140% per year destroys their return on equity and makes the entire precious metals operation unprofitable. Third, and this is where China's actions become absolutely critical, the physical supply these banks assumed would always be available to cover their shorts if absolutely necessary just got cut off at the source. Remember those 44 licensed Chinese export companies we discussed earlier? They control 60 to 70% of globally traded refined silver. The Chinese government isn't banning exports outright, which would violate trade agreements, but they are making sure that every ounce that leaves the country goes through companies they have complete oversight of. And those companies now face domestic demand that's far more profitable than export markets. According to the World Gold Council and commodities research from major investment banks, Chinese domestic buyers are currently paying premiums of $7 to $8 per ounce above Western paper prices. If you're one of those 44 licensed export companies, why would you sell to Western dealers at $70 when Chinese manufacturers and investors will pay you $78 for the same metal? The export licenses aren't forcing these companies to sell overseas. They're just controlling who has the right to make that choice, and increasingly, the choice is to serve domestic demand first. The Federal Reserve's $17 billion emergency cash injection on December 26th, buried during the holiday week when nobody was paying attention, suddenly makes a lot more sense in this context. One or more major banks needed immediate liquidity, and the Fed provided it through overnight repurchase agreements without any public explanation of which institutions required the funds or why. That's not normal even during year-end, when banks typically need extra cash for window dressing their balance sheets. $17 billion is an enormous sum for an unexplained overnight operation. Market participants who follow precious metals trading closely noticed that the timing of this Fed injection coincided almost exactly with silver's explosive move through $80 per ounce and the subsequent violent correction when CME raised margins. If a major bank faced a margin call large enough to threaten its ability to meet obligations to its clearing members, the Fed would absolutely step in quietly to prevent a default that could cascade through the entire financial system. We can't prove this is what happened because the Fed does not disclose which banks use its emergency facilities, but the circumstantial evidence is remarkable. What we're watching unfold is not a crisis that might happen or a theoretical problem that regulators have time to manage. This is a real-time collapse of the paper-silver pricing mechanism under the weight of its own contradictions. Banks sold more silver on paper than exists in physical form, collected decades of premiums, and trading profits, paid billion-dollar fines when caught manipulating prices, and assumed they could continue the game indefinitely. Basel III capital requirements, plus Chinese export restrictions, plus physical market decoupling, equals a mathematical impossibility that no amount of financial engineering can solve. The shorts must cover, and there's not enough physical metal available at anywhere near current prices to allow them to cover without sending silver into triple digits. Let's do the math that Wall Street desperately hopes you won't do, because once you see these numbers, you'll understand why $100 per ounce isn't a price target or a speculation. It's a mathematical inevitability baked into the calendar over the next 30 days, and the only question is whether the paper market survives long enough to reflect what's already happened in the physical world. January 20th arrives in 6 days, and that date represents far more than a symbolic deadline for Trump's proposed credit card interest rate cap. It's the moment when our largest banks must simultaneously manage two catastrophic profit squeezes that converge on the same balance sheets, often within the same trading divisions. On one side, they're staring at the potential loss of over $50 billion in annual credit card interest revenue. That's not a one-time hit. That's $50 billion per year that disappears from their income statements if any version of the rate cap becomes reality through legislation or voluntary industry adoption under political pressure. Now layer on top of that the hemorrhaging from their precious metals desks. Every dollar that silver rises costs these banks real money on their short positions, and we're not talking about theoretical mark-to-market losses that might reverse tomorrow. We're talking about margin calls that require actual cash to be posted right now to maintain positions. When silver jumped from $70 to over $90 in less than 2 weeks, banks holding short positions faced margin requirements that increased by hundreds of millions of dollars collectively. They have to post that cash to their clearing members, or they have to close the positions by buying silver in a market where physical premiums are already at 80% above paper prices. Here's where it gets truly fascinating from a mathematical standpoint. Citigroup analysts who work for one of the largest banking institutions deeply involved in these markets just moved their official price targets to $100 for silver and $5,000 for gold for the first quarter of 2026. Let that sink in for a moment. A major Wall Street bank, whose precious metals desk likely holds significant short positions, just told clients that silver is going to $100 within the next few months. That's not bullish speculation from gold bugs on the internet. That's institutional capitulation to the reality that the paper pricing mechanism has lost control. But here's the part that Citi's analysts understand, but probably can't say explicitly in their research reports. Those price targets of $100 for silver and $5,000 for gold assume that paper markets continue to function as price discovery mechanisms. What happens when physical decoupling becomes so extreme that paper prices become completely irrelevant? We're already seeing it in parts of Asia where dealers won't sell physical metal at any price close to the COMEX quote. They're using COMEX as a reference point, and then adding premiums of 50, 70, even 100%, depending on the form and quantity you want to buy. When physical premiums consistently exceed 50% of the paper price, the paper market has ceased to function as anything meaningful except a casino where banks shuffle contracts among themselves, while the real world moves to entirely different pricing. Industrial users who need silver for manufacturing can't wait for COMEX to figure out its problems. They're paying whatever it takes to secure physical delivery, and those prices are setting the true market clearing level. $100 on COMEX might coincide with $150 for physical delivery, which means the real silver price has already moved far beyond where the charts suggest. Let me take you back to 1980, because a lot of people are going to make comparisons between what's happening now and the Hunt brothers' silver squeeze, and those comparisons are exactly backwards in the most important ways. Back then, Nelson Bunker Hunt and William Herbert Hunt, two brothers from one of the wealthiest families in America, tried to corner the silver market by buying up massive quantities of physical metal and futures contracts. At the peak, they controlled a significant portion of the world's deliverable silver supply, and the price shot up from around $6 per ounce to over $50 in just a few months. Regulators watched this corner develop and decided to crush it by changing the rules. The CFTC and the exchanges implemented what became known as Silver Rule 7, which restricted how much silver any single entity could hold and dramatically raised margin requirements specifically targeted at making it impossible for the Hunts to maintain their positions. The brothers couldn't post the additional margin, were forced to liquidate, and the price crashed back down. The system broke the corner by changing the rules, and everyone learned that you cannot corner a commodity market when regulators control the exchange mechanisms. Now flip that situation completely around, and you'll understand what's different this time. China controls 60 to 70% of globally traded refined silver through legal licensing of 44 state-approved export companies. That's not a corner in the traditional sense. That's sovereign control of physical supply chains that Western regulators cannot touch through exchange rule changes. The Chinese government isn't manipulating markets illegally. They're exercising their right to manage exports of strategic materials, and they're doing it through a bureaucratic licensing system that's completely legal under international trade law. Meanwhile, Western paper markets have sold 300 paper claims for every ounce of physical silver that actually exists and can be delivered. The regulators can raise margin requirements all they want, but they cannot print physical silver bars to meet delivery demands. In 1980, regulators changed the rules to break a corner and protect the shorts. In 2026, regulators cannot change the fundamental reality that China controls the physical supply, while Western banks are naked, short against delivery obligations they cannot fulfill. Here's what you need to watch over the next 30 days, because these three specific triggers will tell you exactly when the paper market finally breaks completely. First, watch for CME Group to announce a third round of dramatic margin requirement increases when silver breaks through $95 per ounce. They've already raised margins twice. When silver pushes toward 100, they'll have no choice but to raise them again to protect the clearing system from defaults. That third hike will force another wave of liquidations and might create one more buying opportunity before the final leg up. Second, watch the major silver ETFs, particularly SLV, managed by BlackRock. According to recent prospectus updates that few people noticed, BlackRock added language giving themselves the explicit right to suspend creation of new shares if they cannot source physical metal to back those shares. That language wasn't in the prospectus before, which tells you that BlackRock's lawyers see a scenario where physical silver becomes unavailable at any reasonable price. The day SLV suspends share creation, or any other major silver ETF makes a similar announcement, The paper market will gap violently as investors realize they cannot get exposure to physical silver through traditional financial instruments. Third, watch for announcements from major banks about restructuring or closing their precious metals trading desks. We already know Scotiabank exited completely. If JP Morgan, HSBC, or any other major market maker announces they're shutting down or merging their metals operations, that's the final signal that the game is over. These banks don't exit profitable businesses. They exit businesses that have become existential threats to their balance sheets, and a precious metals desk that's massively short going into a supply crisis qualifies as exactly that kind of threat. When any one of these three triggers hits, physical premiums will widen to 100% or more almost immediately. That means if COMEX shows silver at $100, you won't be able to buy physical metal for less than $200 anywhere in the world. At that point, the COMEX price becomes a joke, a historical artifact of a market structure that no longer functions. The real silver price will be whatever physical dealers can get in arm's length transactions with actual buyers and sellers, and that price will be determined by industrial demand competing with investment demand, competing with Chinese domestic demand, all chasing a supply that cannot expand quickly enough to meet it. $100 per ounce is not the ceiling in this scenario, it's the floor. It's the base level that physical markets have already established in parts of the world where paper prices have been rejected as fiction. From that floor, the price will move based on how desperately industrial users need the metal for solar panel manufacturing, electronics production, and other applications that cannot substitute other materials. When you're building a solar panel factory that represents billions of dollars in investment, and you need silver to make the panels work, you'll pay whatever it takes to secure a reliable supply. That puts a floor under prices that's far higher than $100. For those of us watching as Americans who want to understand where our financial system goes from here, the message is not to panic, but to recognize reality. The banks that suppressed silver prices for decades through manipulation, paid billions in fines when caught, and continued the game anyway, have finally hit a wall they cannot manipulate around. Basel III capital requirements, Chinese export licensing, and physical market decoupling have created a perfect storm that makes their short positions untenable. They must cover or exit, and either action sends prices significantly higher. This is not about betting against America or rooting for our banks to fail. This is about understanding that a broken pricing mechanism is finally getting corrected by forces larger than any single institution or regulator can control. The next 30 days will show us whether the paper market can adapt to this new reality or whether it breaks completely and gets replaced by physical-only pricing that was already emerging in Asia and other parts of the world. Either way, $100 is just the beginning of silver's repricing to reflect decades of supply and demand fundamentals that were artificially suppressed. The shockwave is here, and the only question left is how high the price goes before a new equilibrium gets established in a post-paper silver world.